This week on the Bearded Banker podcast, we discuss how your debt is impacting your mortgage qualification, 401ks for more than retirement. What if I told you I can qualify you for a home with no income? Update from the Fed, and a 1-point drop in credit score cost a borrower $1,500. Stay tuned. What's up, everybody? Welcome to the Bearded Banker podcast, hosted by yours truly, Daniel Valencia, team leader and senior mortgage loan officer, NMLS number 957014. On this podcast, we discuss everything mortgages, money, and mindset. If you're listening, you may not know, but you can watch the video of this podcast on YouTube. And if you're watching, if you don't know, you can listen to this podcast on your preferred podcast platform. Either way, I appreciate you for taking the time and hope you find it valuable. And if so, you can do all the things that we know the almighty algorithm loves. But for now, just sit back, relax, and enjoy the episode. Welcome back, and thank you for joining podcast episode 17. So we're talking about a couple different things this week, from things that happened last week and some scenarios and things to go over as far as clients, Fed updates, and more. So paying off debt to qualify either for DTI or credit score or both, using 401k funds for a home. We have a new product or an introduction of an old product, no ratio loan. We'll go over that. So no income qualification, Fed update as far as rates, and an interesting scenario with a borrower's credit score dropping 1 point and costing them some money. So we'll jump right in here. So paying off debt to qualify either for DTI or credit score or both. So sometimes when qualifying for a mortgage, people will need to adjust some things in order to make the numbers work. Now, there's a couple things we can adjust. It's debt to income ratio. That's what we use to determine how much of a loan you'll qualify for if you're looking to buy a mortgage, right? So the mortgage payment has to fit into that nice ratio percentage, and as long as it's under a certain number, depending on the program, you will qualify. Now, the two things we have to control that are obviously debt and income. So it's a debt to income ratio, right? So if you make $10,000 a month and you have $5,000 in debts every month that you have to pay, you have a 50% debt to income ratio for easy numbers. So if you want to adjust that or tweak that, we can either increase the income, decrease the debt, or both, right? And we had a scenario where a client needed to do just that, actually a big purchase price, over $1 million, putting down over 20%. But the loan was still, $1 million loan or so. So obviously that's a lot of mortgage to be able to afford. So what they had to do was pay down some debt. Now, increasing income would be great, right? If we could all increase our income, we would. It's just not as easy as sometimes paying off debt. The way we increase income would be adding a cosigner, right, to show that their income is coming into the file. The problem with that is you can't take, the income and not take the rest of the person's history as far as their credit score, their debts, things like that. So if you're going to add somebody, you have to also include the negative, right? So you get the positive increase in income, but you also have to include any debt. So when adding someone to a file, you definitely want to add someone that has credit as good or better than yours, because we go off the lowest credit score of anyone on the file. You can have up to 4 people on a loan. So we want to make sure their credit score is as good or better than yours. And hopefully they don't have a lot of debt and they make really good income, right? You want to think of someone that would be in good shape buying a house on their own, or if they already own a house, is in good shape financially, that will help you with your file. Because the worst thing that can happen is you bring someone on that has worse credit than you or more debts then they have money coming in, and that actually hurts the file more than it helps it, right? So that's one way of increasing income. Now, the other way is decreasing debt. So decreasing debt is paying things off, right? So let's say you have a credit card that has a $5,000 balance and a $100 monthly payment, and if we get rid of that $100 monthly payment, it'll help your debt to income ratio. We want to be able to pay that off and hopefully still have enough money for down payment and closing costs. Now, when we're assessing debt to income ratio, we're looking at the minimum monthly payments that are due. We don't really care about the balance, right? You could owe $1 million as far as balance is, not really important. Everything is based on monthly income, monthly debts, and what it looks like you can afford going forward. So if that same credit card, again, $5,000 balance, $100 payment, we have to get rid of that. Can we get rid of that, still afford the down payment, and still afford the closing costs with, using that $5,000? Or do we need gift funds or some money to come from somewhere else? So the other side of that, in this particular case with this client, was paying off the debt could potentially also help their credit score, right? Because when you pay down the debt, your credit score should increase. Now, it's not always the case that we need to do both, right? Sometimes we need the credit score at a certain level to qualify. So the debt is okay as far as debt to income ratio, it qualifies, but the score itself is under the threshold. Most times 620 or lower is going to be under the threshold for conventional loans. FHA will go down lower, but for the most buying power, you want to be 620 or higher. So if we're under that, maybe we could pay off some debt and do a rapid rescore where we get the bureaus to update the scores faster than they would normally, right? Because most times, if you pay something off now, you don't see the impact on your credit score for about a month when the credit bureaus report that information, or the creditors report that information to the credit bureaus. What we can do is a rapid rescore. We say, okay, to our credit pulling company, hey, this client just paid this off. Here's the proof. Here's the documentation. Here's the updated balance. It's showing 0 from the creditor. Go ahead and update that before that month comes, before the creditor reports it. Let's go ahead and update it now so we can get a rapid rescore back and get that score up to where it needs to be, right? So that scenario is just for the score. We got to get you over the threshold. The debt is fine as it were. If you had a 700 score, we could do this right now, but we have to get the score up to get you buying power or the best terms or the low down payment, whatever we need to qualify you. So that's one aspect. The other aspect is we can't qualify you with this debt to income ratio. So your credit score is fine, 700, 800, but you have too much debt to qualify. So let's go ahead and pay some of this stuff off. Now, in some cases, it's both, right? Where you need the debt to income ratio lower to qualify and the score isn't where it needs to be. So it's like, let's definitely pay off these couple of things that'll help your debt to income ratio and also increase your score. We'll do a rapid rescore, get this back in a week or two, and then we're all done. Everything qualifies, you're in good shape, and we make sure we don't touch those things while we're still searching for homes, so we can get you pre-approved and then make sure that we keep those things in line. So that's something we had on a pretty big loan amount, pretty big file, where the credit score was okay, but the debt was more of the problem. Now, the added bonus of paying down this debt will be hopefully that the credit score increases. We don't necessarily have to do the rapid rescore and go through that added cost of doing so. But if in a month they're still under contract or looking for a home or whatever the case is, and their apps that they use, right? Because most of us track our credit scores either on our credit card apps or Credit Karma, or the app I like the most, My FICO. And you can look into that app. I like it because it breaks down your credit for different types of borrowing, which is important because credit scores are different depending on what type of credit you're looking for. Credit cards are different than car loans, are different than mortgages. So your scores will vary based on who's pulling it. But I like those apps. So once we see that on your end, you see that your scores have gone up, we can go ahead and re-pull your credit and then, again, get, kill two birds with one stone, where we are getting the better credit score and getting the lower debt. Now, to piggyback off of that with debt to income ratios, I had probably 2 or 3 conversations this week, and this is a good sign that people are really in the market and looking to buy, because I'm getting inquiries like, hey, we're looking to buy end of this year, early next year, or now, and I'm just trying to figure out some numbers before I actually apply. Now, our advice is always, hey, just fill out the application because it is a soft credit pull, and there's no obligation, there's no fee, it's completely free. So might as well just fill it out now so we can get some numbers in the system, and then we can let it just kind of hang out there until you're ready. But if you don't want to do that yet, we can definitely go over it kind of back of the envelope math. And I had the same conversation, probably 3 times. A couple different friends, all with current properties now looking to upgrade and knowing that they're going to have to increase their expense on their mortgage just because of where rates are, where prices are. So if they're going from, a $3,000 mortgage payment now, maybe to $4,000 or $5,000 to get what they want, and trying to figure out how that works. So again, along this same vein of debt to income ratios and qualifying, let's assume their credit scores are all fine. It's like, okay, now I want to know how this debt is going to impact my qualification, right? Or no debt, right? Because I want to be at $5,000 a month. So we do some quick calculations. We say, okay, how much do you make, you and your spouse, if you're both going to be on the loan, per year gross before taxes? They give me a number divided by 12. That gives us a monthly amount. Now, if they say we want to be at a $5,000 monthly payment and they have no other debt, then they have to make at least $10,000 a month, right? $120,000 a year, $10,000 a month. 50% of that debt to income ratio is about $5,000. We want to be lower than 50% if we can, but just for easy math, somewhere in that range. Now, some of them had other debts, right? A car payment, student loans, things like that. So they actually have to make more in order to qualify for that $5,000. And some of them are like, hey, I just want to know, what my buying power is price-wise if I'm at $4,000 a month, what my buying power is price-wise if I'm at $5,000 a month, and playing that game. So sometimes what we qualify you for is actually higher than what you're comfortable with. And that's actually happens pretty often because we only use gross income, not net take home, right? So gross before taxes, and your minimum monthly payments from your credit report, right? So it's not including daycare costs and groceries and utilities and all these other things. So the number we give you sometimes might be higher than what you're actually comfortable with. And in most cases, especially with these more qualified buyers or buyers that already own property, and every scenario I've talked about so far, they all own property already. Even the $1 million one, they have a property they're going to keep and rent out, and they want to move into this $1.5 million house, but keep that property. So they all already have that ownership, and they're looking to buy another property. So they're increasing their expense a little bit. So trying to back into that number, we have to account for a couple things, right? If you want to be at $4,000 or $5,000 a month, we have to take out some things to determine the loan amount you'll qualify for. So you have to take out property taxes, take out home insurance, take out mortgage insurance or PMI if they're going to have it. A lot of them won't, but if they do, we have to take that out. And then whatever's left is what we can calculate a loan amount on, right? So let's say, for example, their budget is $5,000. And let's say taxes, we're in New Jersey. Most of these scenarios are in New Jersey. So taxes are $12,000, $15,000 a year, something like that. So let's say $5,000, $1,000 a month for taxes. And then let's say another $250 for insurances and things like that. So that's $3,750 left as a payment, right? And on a 30-year fixed, let's say rates right now are 6.5%. That's a loan amount of $590, $593. So we say, okay, based on this payment where you want to be, if taxes are $12,000 a year, you can get a loan of about $590, and then whatever you can put down would go on top. So if you have $100,000 to put down, or you're going to sell a house and you have $200,000 to put down, you can go $590 loan amount, $690, $790 purchase price, $790, $800, somewhere in that range. And then it's up to you to go find that property that makes sense if you can find what you're looking for at that price range. And obviously with the value and prices going up, can you find what you're looking for in the areas you're looking for? Do you have to expand a little bit further out? So that number, right, would say, okay, 5,000 gets me there. Where would 4,000 get me? And maybe it's $100,000 lower. So instead of looking at 8, you're looking at 7, and trying to figure out what you're comfortable with as far as your monthly budget. Because assuming that you qualify, right, we've already looked at all the numbers, done some back of the envelope math, you don't have any debt, then we can make that happen. Now, let's say that your combined income is $10,000 a month and you have $2,000 a month in car payments, credit cards, student loans. That only leaves $3,000 for the total mortgage payment, including taxes, insurances, and everything, right? So that's how debt can impact your buying power. Because now instead of being at $5,000 a month, even if that was a little high for you, you wanted to be around 4, well, you only qualify for 3. And then what house can you get at 3? Maybe $600,000 house, $500,000 house, right? Depending on property taxes. So it's definitely a huge impact on qualification when you have extra debt. So that's something you want to be mindful of. If you have no debt, all of your buying power, all of your debt to income ratio can go directly towards the mortgage payment, because you don't have anything else that's, trying to grab from that to make payments every month. Credit cards, student loans, personal loans, car payments, other mortgages, things like that. So those are the scenarios we went over with some clients this week, seeing a lot of activity, having a lot of conversations around debt and qualifying. So I wanted to bring that up first on the pod so you guys can have some background on that, whether you're a first-time home buyer or looking to acquire more property or refinance, whatever the case is. It's all the same game. It's monthly income before taxes, so gross monthly income versus minimum monthly payments on your credit report only. And that's how we qualify you when we throw a mortgage in there. What do you ultimately qualify for? Now, if you're self-employed, we look at the numbers, whether you're self-employed or salary employee, whatever it is, we look at the amount of income you're going to pay taxes on. So for an employee, W-2, you pay taxes on your gross income. For self-employed, 1099, sole proprietor, whatever, business you have, you pay taxes on your net income after expenses. So it's still considered gross before taxes, but for self-employed, it's actually net after expenses, right? So you have your top of the line, what you brought in, all your write-offs for your business expenses, then that net number that you actually pay taxes on, that's the income we use for you, and we actually average it over 2 years. If you're self-employed, you have more questions, this is the time to go over them if you're looking to buy, because it's tax season. Let's figure that out now and try to get some numbers together, get a draft tax return, look at your last year or two, and average all that out. And if you've been in business for 5 years or longer, 99% of the time we can use just your most recent year of taxes. So we can make this year look how it needs to look, qualify, close, boom, all done, and then kind of only have 1 year of a big tax bill that you have to bite off. So that's scenario number one. A couple different scenarios in there, but just with debt for qualifying purposes and things like that. So I'm going to switch this up a little bit. Instead of going to the 401ks, I'm going to go to the new product because it's kind of just keeping in the same vein that we just went over as far as income. Now, let's say that you are someone that doesn't show a lot of income on paper or has a lot of assets saved, right? Money to put down and beyond that. But the way you work or the way your income is generated, it doesn't, show on paper. It's not a salary. It might be variable, whatever the case is. There's a new product, or actually a returning product, we call a no ratio loan, where we don't look at any income documents at all, right? So it's just your credit score and your cash, right? So you need 20% down and you need reserves. So if you have 20% down plus closing costs, and then you have additional money beyond that, which they want to see, right? Because they're not looking at any other documents. We're not looking at W-2s, pay stubs, tax returns, anything. All we're looking at is the amount of money you have in the bank, 20% down plus closing costs, and if you have about 12 months, maybe even 24 months of mortgage payments left beyond that, you can qualify for these no ratio kind of loans. Yes, the interest rates are higher, but again, they're not looking at anything as far as income. They're basically saying, okay, you have money in the bank, plenty of money in the bank, you could put the down payment, cover closing costs, and you have a year or two of mortgage payments beyond that, we'll do a loan for you. Here are the terms. If the rates are 6%, 7% now, they're probably going to be 8, 9% with this program. But again, you're not looking at any in-depth tax return or income documents where every other bank is saying, hey, for a conventional FHA, any type of conforming loan, we need to see all your documents. We don't even have to do that. Even some 1099 loans or bank statement loans, right? They still want to see activity every month. We are just like, hey, I have this money sitting. I get money in big chunks every year or two, whatever the case is, but here it is. That could be a good program for you. Or if you're self-employed and just on paper it's not really working, as long as you have a decent credit score and you have that money, we can definitely do that for you. And the entire down payment can be a gift, right? So it doesn't even have to be your money for the down payment. So if you have enough money for the reserves, 12 months, 24 months of mortgage payments, right? Going back to our last example, let's say that mortgage payment is going to be $5,000 a month and you have $60,000 or $150,000 in an account saved and your credit is good, you can do this loan, this no ratio loan, have your $5,000 monthly payment, say I have 2 years of reserve saved and my parents are going to gift me money for down payment, all 100% of the down payment and closing costs and everything, and we can do those loans up to $2 million. So that's a really great program. And now piggybacking off that, so that's 2 scenarios there, 2 points we wanted to go over this week. The third is using 401k funds for a home, right? So had a couple scenarios this week, talking with people through different examples of using retirement funds for down payment. So in that example with the no ratio loan, You can do that. Say, look, I have 150,000 saved. I'm not going to use it for down payment and closing costs. My parents are going to gift me the down payment of 20%, which might be, 100 grand, 150, depending on the price point you're looking at. So your parents have money saved, liquid. They're going to, gift that to you. That's one option. The second option is you have money in a retirement fund. So let's say you have this liquid money here for reserves, and then you have money in a retirement fund, like a 401k. You can actually borrow against the 401k penalty free for a first time home buyer and use that money towards down payment and closing, right? Also, let's say you have the liquid money, 100,000, 150,000 for down payment, and then your 401k or other assets, stocks, other retirement IRAs, whatever it is, you have 200, 250,000, $500,000, whatever's there. We can use that as reserves. We don't even have to touch it, and use the liquid funds as down payment. So there's a lot of ways to play with assets once you have them, and gifts. If you have family members that can gift money to you, whether it's liquid, retirement accounts, wherever they want to get it from is up to them. But there's plenty of ways we can make it happen. And with all these loan products, you don't have to necessarily worry about qualifying conventionally or giving all this income documentation. Yes, if you do give all the income documentation, tax returns, W-2s, pay stubs, all that, you're going to get the best rates and the low down payment options. But if you don't have all that, if you're cash heavy, self-employed, you run a business that makes a lot of money, you don't really show it on taxes or claim it, definitely talk to your CPA about that. I'm not a CPA, but we have programs for you too, where it's one or the other, right? You can either do the low down payment programs because you don't have a lot of assets, but you have the income documented, so you want to use a first-time home buyer low down payment program. Or if you're the opposite, you don't show a lot on paper, but you have the money saved, you can do these other like no ratio options. So using the 401k could be great. I had another scenario with a friend that said, hey, once I sell this house I'm in, I want to use some of that money to pay off some debts and use the rest of it for down payment, or I can use 401k money to pay off the debts now and just use the money when I sell for the down payment. My advice was, don't touch the 401k for the debts, because as soon as you take money just because either they call it a hardship loan or borrowing against your 401k, you're going to get penalized on it if there's not a good valid reason. Penalized and taxed because you're taking it before retirement age. So leave that alone. I would say use your liquid money, right, when you sell to pay down whatever debts we need to pay down, and then just borrow from the 401k for down payment and closing costs, because 99% of the time I say that a lot this week, right? 99% of the time. 9 out of 10 times, but majority of the time, a 401k provider, right, whoever you use or your company uses to house your 401k, they're going to ask for a couple things in order to give you the money. And one of them is the loan estimate, the mortgage documents that are going to show how much you need, right? So I had a client ask, or actually their realtor asked for them, hey, the client wants to borrow from their 401k. Can they request, let's say, $50,000, only use 30 towards the purchase of the house, and then use 20 for other things? And I said they can check. It definitely varies depending on provider, but majority of the time, the 401k provider is going to ask for the mortgage documents to see how much you actually need and give you that amount of money towards the purchase of a house in order to give it to you penalty and tax-free. Otherwise, if it's beyond, money beyond that, they might not give it to you, one, or if they do, it's going to be penalized and taxed as just a separate loan. A lot of 401k carriers as well will not give you two loans at one time or let you withdraw twice, right? So if you already have an outstanding loan, usually that has to be paid back before they'll give you any money for the purchase of a house or a second loan or whatever it is if you're borrowing against yourself. The good thing about borrowing against yourself is if you borrow from your 401k, we don't necessarily have to count that against you because it's your money. You're just borrowing, from yourself. So it's not like another debt like a credit card or a car payment or anything like that. Moving along, guys, we're cranking this week. So we're going to give an update on the Fed. Had a pretty big meeting this week. Anticipation was high to see what the Fed was going to do, Jerome Powell and them. And they did exactly what we thought. They held rates right where they are. So they don't think a March rate cut is likely based on this meeting and based on the current economic indicators. They don't think it's likely. When asked about housing affordability, Powell said the job Congress has given us is price stability, and price stability is the most important for people at the margins of income. And the tool we have for that is interest rates. So he kind of beat around the bush like they usually do when they get these questions. Basically, what he's saying is housing affordability doesn't matter to us. Our job from Congress is to stabilize prices, because prices ultimately determine what people have to pay for cost of goods to survive, to live, groceries, gas, things like that, power, electricity, all that. So they want to stabilize prices. If that impacts real estate and home buying negatively, so be it. That's not really their goal. Their goal is price stability, and the tools that they have for that is interest rates. So unfortunately, all the Fed can really do is say, we're going to raise interest rates or we're going to cut interest rates. And whatever the consequences are of that on housing are separate from their ultimate goal of getting inflation down to that 2% target. So I thought that was interesting that Powell was specifically asked about housing affordability, and he kind of beat around the bush there and just said basically, we don't care, which they do care, right? They do want a strong economy, but their particular job is, again, price stability. So that's what they're focused on. And I mean, they keep calling it a soft landing, right? Which is basically like from the rate cuts of the pandemic and stimulus that was added into the economy and printing all that money, we could have easily had a crash landing and recession if the Fed didn't jump into action. Now, whether or not they did it at the right time or should have done something sooner, that's debatable. But just the way they're handling it, they're trying to orchestrate what has been called a soft landing, which is basically just coming to a nice soft stop of getting inflation back down to where it should be. Now, depending on what industry you're in, it has been nice and soft, right? It's been harsh, especially in real estate, mortgage industry, and some other industries as well. But they're getting close, right? We're already talking about rate cuts, job employment overall, right, is strong. The job market is strong. There are layoffs and some things coming, but that's normal for industries. A lot of earnings came out for some of the big companies, tech companies, Facebook, Amazon, Google, I believe, and they were all pretty strong and better than expected. I mean, Facebook or Meta went crazy this last week. They actually gave a dividend, which hasn't been done in tech, I don't think ever, but that's basically a sign that they're being very disciplined with their finances, which is good. And typically when a company gives a dividend or starts that practice, they don't go backwards. Like, you can't give it and take it away. So if they're introducing a dividend to their shareholders, that's a good sign to show that they're disciplined with their money and they plan on doing that into the future, and also just how much money they're making. So that sent the stock kind of crazy and skyrocketing. So things are, relatively good. Another quote, Powell said, we want to bring inflation down while keeping job market strong. We just went over that. That's basically what's happening. So that's the update. They don't think a March rate cut is likely. We'll see what happens. The next meeting, let me just pull up my calendar here. Actually have these. If you're in the industry, you should have these kind of scheduled out so you know when the meetings are and when they're going to be talking next. Wednesday, March 20th. It's always during the middle of the week. Wednesdays, 2 o'clock is when Powell speaks. So we got March 20th, May 1st, June 12th, July 31st, September 18th, which is my birthday, November 6th, and December 18th. So those are the meetings for this year. We'll see what happens. But again, no March rate cut is likely. Okay, so last thing we're going to discuss for this week as far as some mortgage stuff. And I thought this was pretty interesting and something to point out. I had a borrower that's purchasing a home. She's purchasing an investment property down in Florida. She actually lives in Florida and is buying up some more property down there. She's married, but she wanted to do this alone. So she's the only one applying and qualifying by herself. And we ran her credit back in, let's say, November, right, to start the process. Got under contract. Now she's looking to close probably this week. Now, it took her about a month or two to get something under contract. So we did that hard credit pull, let's say November. She got under contract in, let's say, December. And then we started working on the loan end of December, early January for a closing now, right, February. So what happened was she had a number of different jobs, kind of the typical remote worker, and it's in healthcare, and all her employers know that she has multiple jobs, and she kind of does some 1099 work on the side, some W-2 work on the side, so it's a couple different jobs. And we did all the calculations. She owns some of the property, other investments, and when the income was reviewed by underwriting, they saw that it was actually declining. So she wasn't making more money every year. She was making less year over year based on year 1 to year 2. And not much, but enough to cause some questions. And again, this is a conventional, we're looking at everything kind of loan. And unfortunately, her only excuse was that she took some time off for family, for vacations after the pandemic, right? To kind of get away, get out of the house. Again, remote worker, been indoors, probably pre-pandemic, but at least a couple of years. So last year, she kind of got out of the house, started traveling a little bit. And because of that, her income declined, which didn't hurt her. She could afford it. But on paper, it just looks like things are getting worse, not better. And that's always going to be a red flag to an underwriter. So when all that was reviewed, her debt to income ratio no longer qualified by herself. So what we had to do was add her husband to the loan. Again, going back to what we spoke about in the beginning, having a cosigner. Now, husband, software engineer, makes great money. Didn't want to add him on if we didn't need to, just because it's more paperwork, more bothering him. He's a busy man, and just trying to get all that under control with 2 people and all these jobs and all this documentation can be a little bit more difficult than it needs to be. He can still be on title, still be an owner, whatever, but we weren't going to put him on the loan. When we hit this speed bump, we had to then add him on, which is no problem. I knew the debt to income ratio was going to cut basically in half, if not more, because his income and credit was really strong and didn't have a lot of debt. So unfortunately, when we did that, when we added him to the file, what I wanted to do was just use the credit report we had for her and add him on and merge those reports. So not necessarily re-pull her credit, just pull his credit added with hers that we already pulled back in November. The problem with that is most credit pulling agencies, the one we use, and I researched it, so almost all of them, will not let you add a spouse to an already existing report if the original report is more than 30 days old, right? Because now there's new information that could have hit, so it's just not allowed from the credit agencies, and even from underwriting and mortgage guidelines are going to say, hey, we need a fresh report for both of them, which is fine. Credit was excellent. I wasn't really worried about it. Good to go. When we did it, unfortunately, the main borrower, the wife's credit score actually dropped about 7 points. So it was 786, which is excellent, dropped down to 779, which is still excellent. But because of that, and his score was better. So again, we used the lower of anyone on the file. So in this case, it was 779. Because it was under 780 by 1 point, the pricing changed for the interest rate. So going back a little bit, when we originally got that contract, submitted it to underwriting, we locked the rate, nice low rate. Let's say it was costing, 1 point, 1% of the loan. It might have been $2,000, something like that. Now when we pulled the credit, repriced it, it's already locked, but now the same rate, because her score went down under 780, it actually changed the pricing of the rate. And what that means is we can give you the same rate. It's just that with the lower credit score, which is crazy, right? Because it's still 779, but it is lower because these credit score and pricing as far as rates work in tiers, 20-point tiers. So it's usually like 620 to 640, anywhere in that range is one rate. Or let's say 620 to 639, right? Then 640 to 659 is another. Then 660 to 679 is another. Then 680 to 699 is another, right? All the way up to where we're talking about 780. So she's actually got bumped down from the top tier to the second tier because of 1 point in her credit. And it's not like she did anything wrong. It could be that she used a credit card and the balance went up a little bit from 500 to 900, which is nothing for her. But it changed her score from 786 to 779 on her middle bureau. We use the middle score for each borrower. So every borrower gets 3 scores, Experian, TransUnion, Equifax, and then the middle score for every borrower is their individual qualifying score, and then the lower of anyone on the file is the overall qualifying score for that file. So unfortunately, again, hers dropped 7 points, dropped her score by 1 point under the threshold, and instead of being $2,000 for the same rate, it was about $3,000 or $3,500. Now, in most cases, going back to what we spoke about in the beginning, I would just do a rapid rescore. Hey, just pay this card off. let's, do a rapid rescore, get it back to 780, 782, 790, right? And just keep the same rate. Unfortunately, they wanted to close like this week. So we didn't have time to do all that. And she didn't really want to go through the headache because you're going to use that money to pay down a credit card anyway. Just use the money, put it toward the rate, and then we could always do a refinance because we are still expecting rates to drop in 6 to 12 months. So let's not waste too much money on going back and forth and doing these extra rapid rescores. Either keep the same rate or we can bump the rate up an eighth and you keep the same cost out of pocket, and then we'll do the refinance when rates drop and get you a nice low rate where at that point you pay as many points as you can to get the lowest possible rate and never have to touch this mortgage again. Because when these rates drop this next time, everyone should be buying the lowest possible rate they can get and then not touching it, because rates probably they're definitely not going to go back to COVID levels, probably not going to go back anytime soon to where they dropped to this time around, depending on how long they last at that point, which will probably be a year or two because it's election time, new president, rates will drop down, and then they'll probably start to go up after a year or so. So that's kind of the advice. We were able to do that, get it cleared to close and wrap that up. But it's just crazy that 1 point changed her cost by an extra $1,000 or $1,500. So that's something to discuss with your loan officers as well. See where your score is when it gets pulled, see where it lands and what that gets you. Rates work on a spectrum, right? So there's really low rates with high closing costs, and there's higher rates with lower closing costs. Most people end up somewhere in the middle of that spectrum, depending on what they're willing to pay or not pay. And we can look at that and say, hey, especially if it's early enough in the process, you're under contract or trying to qualify for something, we can always look at that rapid rescore. And even if it's not a rapid rescore, even if we don't need to do it that quickly, we can coach you and say, hey, if you can get this, 685 score to 715, we could possibly almost definitely get you better rates. Here's what you would need to do. This card here, let's pay that down or pay it off. This car note, it's almost done. Let's get rid of that. Just some little things we can do so that by the time you're under contract, we can repull your score and see where it's at and get you better rates and better programs and all that good stuff. So, 1 point does kind of make a difference here and there. Unfortunately, or fortunately for her, it happened at the end of her process and the money wasn't really that much of an issue. Obviously, she wants the best rate she can get, the best terms, but it's kind of where the crumbs landed, how the cookie crumbled. What I'm trying to say, it's kind of where things landed. So we move forward as is, but just something to keep in mind when you're applying for a loan, talking to your loan officer. We definitely look for it and look out for it and see how we can get someone from this tier, again, those 20-point tiers, to the next one to get them better terms, where most loan officers are just kind of taking what they have and trying to work with it. Like, if I'm competing with another loan officer on getting the deal, well, hey, I'm looking at trying to get this credit score up, because then whatever rate or term I can give her will be better than anyone else can give her if I can get it up in my system and going that extra mile. Yes, another lender could do that or use the same scores and quote the same thing, but sometimes just doing the extra work up front and showing them that expertise as far as showing the client can really seal the deal for you, and they just want to work with you at that point. So that's it for this week. Very busy week, which is good. Productive week, seeing a lot of inquiries, a lot of people applying and pre-approvals going out, and we're seeing that across the company with all team members, not just on my team, just in general. So that's awesome, and looking forward to a nice spring market. It's been rainy up here, but today is actually nice out, so going to get out a little bit and see what's going on out there in the world. The real estate market, houses, a lot of activity, a lot of competition, and still hoping for these rates to come down. If you're in the market, let me know, and we'll close out. The goal in life is to be mortgage free. Control your emotions, have integrity. If you want to use my likeness, I need equity. And if you're really trying to win, you need to bet with me. Until next week, have a great week. Let me know if you have any questions about anything we've discussed or anything specific to your scenario, and we'll take care of you. Talk soon.